to the April edition of the How to Algo Trade in PineScript series. If you haven't watched last month's videos, I highly recommend them because they're probably some of the most important videos in this entire series, where I talk about the two main kinds of edge in markets and the process and mindset for developing trading strategies that you can actually take live. In terms of the edges that we developed so far, we have a breakout strategy that's long only. We have an overreaction / exhaustion strategy that captures when the market has moved too far too quickly in the downward direction in a bull trend and then fades that. And then last month we covered a mean reversion strategy based around standard deviation, which is typically captured or measured using channels. So with the recent global tariff war that's going on, and the market dump that recently happened, some people have been asking me two main questions. First is, how do we develop a short strategy to capture downward moves whenever SPY is in a bear trend? And then secondly, do I still run my long only strategies when the market is in a bear trend? So let's dive into that. First, we need to categorize the bear trend. And the historical way, the simplest historical way that this is done is by using the 200 SMA. So if we think about what the 200 SMA represents, it represents what price has been doing from now to almost a year ago. And if we are below the 200 SMA and staying an extended time below it, then the market is certainly not moving upward. And it probably is either moving sideways or down, especially if we are giving up or trending down and starting to give up most of the gains from roughly a year ago. Depending on the instrument you trade, you may need to use several context filters for the conditions that you're trying to capture, whether that's a bull trend, bear trend, or trading range. And then depending on the time frame, you may need additional context filters just to filter out more noise. And then depending on the bars that you're using, you may also need some very specific context filters if you're using non-standard bars. So generally, what I would first do, if we take the mindset of a scientist, is first say, well, if we believe that fading pullbacks in a trend has some sort of consistently profitable edge, then we first need to prove that assumption. I'm not going to do that today, and that's just because I don't want to reinvent the wheel. There are plenty of studies going back all the way to the inception of the markets showing that trend following does work. That leg one, pullback, leg two is a consistently profitable phenomenon. But I bring this up because people often ask me, well, how do I capture this idea or this phenomenon? And my first response to them is, prove to me that this is a phenomenon that's relatively consistent, and also that this is even a good idea in the first place. So normally that's where we would start, but I'm not going to rehash prior studies that already prove this. We're going to run with the assumption that has already been proven that trend following works. So what we need to do is identify bullish pullbacks in a bear trend. So this is where creative thinking and the mindset of scientists are required. Some initial ideas, I like to start with the simplest ones. First is, what if we just fade 2 bull closes in a row? Arbitrary reason, not really a good one. I can't explain to you why it'd be a good reason, but that doesn't mean that it shouldn't be tested. So we want to test it and then prove that it's not a good idea through testing rather than just assuming it's not a good idea. A more deep way to think about this to identify bullish pullback might be through the use of momentum. So the prior strategies that we've covered in the past 2 months have in some ways been a way to measure momentum to identify potential reversal points. We're going to be doing that as well here, and also using, or at least testing, one momentum oscillator. So if you're going to use indicators, and I don't think you should be afraid of indicators, but it's important to understand what indicators are doing. So if you use something like RSI, that's a momentum oscillator. And so that's generally used to capture overbought and oversold conditions. The problem is that you don't generally want to be using that arbitrarily. You want to be using that for very specific reasons, such as catching pullbacks. And then other oscillators exist, such as stochastics, MACD, but the trap you want to avoid is just using indicators for arbitrary reasons that they're not meant to be used for. For example, there's some really bad strategies online on TradingView where people try to do some sort of mean reversion thing based on Bollinger Bands, even though Bollinger Bands are not momentum oscillators. And so, yeah, just make sure that you understand the purpose of whatever indicator you're using. And it's good to learn about the different indicators. That way you can kind of put them in a toolbox for what they do. So that way, whenever you come up with an idea that you want to explore, you have a toolbox that you can pull from, because it may be difficult to code what momentum is or code different ways to identify momentum. But thankfully, there are a lot of indicators that are already developed that already do this. And so if you know what those are, then you don't need to go through the hard work of thinking about how to actually capture a measure of momentum, and can instead just use those indicators that have already been proven for that purpose. And then for exit conditions, I like to stick with also simple ones to start. So just closing below the prior day's low. But if we know anything about bear markets, we go one level deeper. Bear markets tend to dump, or they tend to have a lot of volatility. And so maybe something that is a little bit better might be when the market closes below a short-term regression line, like a 5-day SMA, or the one that probably makes more sense here is the 5-day EMA, because the EMA reacts more quickly to sudden price moves. So I've actually listed 3 entry and exit ideas, even though there's 2 bullet points for each, and those together are 9 permutations to try. And that is a lot, but that's what algo trading kind of demands of you, is that you have to be able to set aside the time to try out different ideas, gather data, analyze, iterate, improve, and then either discard the idea because it just doesn't seem to make sense, or eventually tune it to where you have something that seems to be a capturable, consistent phenomenon in the market. So let's go ahead and talk about the first one, which is just 2 bullish closes in a row. This is simple, it's arbitrary, I can't really explain it, so it's not likely to make sense. So here are the rules. We have our context filter, and then we have 2 bullish closes, and then the exit condition. So here is the equity curve. It does not look good. A lot of sideways periods. We have significant drawdown. And even though it seems to perform well recently, my interpretation of this equity curve based on these rules is that these rules are good for capturing some edge in certain bear markets, but not in other bear markets. So basically all we've done is proven that arbitrarily fading 2 bull closes in a row in a bear trend is not really a good idea, at least not with the current exit condition. Now I could go back and analyze and see whether a different exit condition might give us better results, but I have done that actually, but I don't want to show that here because I don't want to make the video super long. So let's go ahead and go a level deeper and think about what is more likely to lead to a mean reversion, or rather a reversal in a bear trend, or rather a reversal in a pullback that resumes the bear trend. And that would be when there's extremely high counter trend momentum that has gone too far too quickly. Well, one way to measure that is using RSI, which, as I mentioned previously, is a momentum oscillator. So if the RSI has an extremely high reading, like above 90, then what if we just shorted that? Well, this is what we end up with. It's actually a pretty good equity curve. The only thing I don't like about it is the lack of trades. So we're backtesting all the way to the inception of SPY, but we couldn't come up with at least 100 trades, which is my personal standard for considering it statistically significant. Depending on your personal risk tolerance and also your standards, you might trade this, and I wouldn't blame you necessarily if you did, because the profit factor is decent, the drawdown is good. I mean, overall the numbers are good. It's just I would personally prefer a little bit higher win rate if possible, and I would prefer at least 100 trades. So one way to interpret this is that what this proves is, if you think about it, the RSI greater than 90 represents extremely overbought conditions. And so this equity curve proves that if you fade extremely overbought conditions in a bear trend, you're likely to make money. And it's a consistent phenomenon, so there's definitely some sort of consistent tradable edge there. So let's think about what are some other ways that we can capture this idea? Because the mistake would be to go take the RSI and then say, well, what if we try RSI above 89, 88, 87? Whenever you start messing around with those numbers like they're arbitrary values, rather than thinking about the general concept of what they represent, is whenever you get something that starts to be overfitted. So what we want to do here, since the RSI was not able to produce a uh, enough trades in the backtest to meet my standards, is we need to use a different momentum oscillator or just a different way of measuring momentum to capture an extremely overbought condition. And this is worth exploring just in general. In this video, I'm not going to be covering like stochastics, MACD, and all the other different momentum oscillators, but I am going to be showing you one, and that is percent change. So if you've gone through the past two strategies, you've already seen some different ways that we can measure mean reversion or likely reversal areas. This is just another way to measure potential of a likely reversal, and that's just through a measure of momentum. So percent change is just today's close minus yesterday's close divided by yesterday's close. And if you multiply that by 100, you get some sort of percentage. One thing I want to mention here is that this incorporates gap ups and gap downs. So let's say yesterday ended as a bear bar and then today closes as a bear bar, but today had a huge gap up. The percent change would actually be positive even though today closed as a bear bar because of the gap up. This is, of course, assuming today's bear close is still higher than yesterday's close. And so if we decide that we're going to use percent change to capture an extremely overbought condition in a bear trend, we have to go back and add the rule that the most recent bars had to be bull closes. Otherwise, it's not really a bullish pullback. It's just gap ups that happen to have bearish closes. And so the rule I'm going to be adding in the next iteration is if the percent change has been increasing 3 days in a row. Note that I didn't say that the percent change was positive. It had to literally be increasing 3 days in a row. So this is a way of capturing the market moving too far, too fast in a bullish direction when the market as a whole is likely to be in a bear trend. So let's go ahead and look at what that equity curve looked like. So these are the revised rules. The percent change had to have been increasing for the past 3 days. And so you can think of that. One way to think about that is three consecutively larger bull bars, although that doesn't necessarily have to be the case. Really, what I've written down as the rule is that the past two closes had to be bull closes. And we keep that same exit condition. This is the equity curve. Now, if you do algo trading long enough, you'll find that a lot of equity curves kind of look like this. And the way I like to interpret this is that this is almost viable. So the general idea is partially viable to trade, but maybe something needs to be tweaked in terms of how it's entering or exiting. And this is where you would take this equity curve and say, well, that looks like it's almost something. And then you go look at the actual individual trades that it took, and you try to figure out where something might be suboptimal. Now, I'm not going to show you where I did that here with this strategy. And part of that's because in the next video, when we actually go and code this strategy, you're going to be able to see for yourself by playing around with the user inputs. But when I looked at the actual trades taken, I recognized that the exit condition was just not ideal. And that's because when a bear trend resumes, when the market is in a bear trend and is dumping, the dumps tend to be large. So rather than just exiting after a close below yesterday's low, what if we have to basically close after, or what if we exit after a dump? And the best indicator that I could find was simply a 5 EMA. So here we've kept the same rules for entry. The only difference is that we've changed the exit condition so that the market has to close below the 5-day EMA. Now you'll notice that I wrote not including today, and that's because if the market is open and we are currently short, but the day has not closed yet, the 5-day EMA will include today's current price, and it'll be moving up and down as the day fluctuates up and down. And that's not something that I want to incorporate into the backtest because we cannot predict where the 5-day EMA is going to close for today if today's daily bar has not closed yet. And so what I'm writing as the exit condition is, or what I'm testing in the exit condition is, what was the 5-day EMA of of up to yesterday's close. So that way we can look at the 5-day EMA from yesterday's close and say, okay, in our conditional exit order, what we do is we say if the market closes below that price yesterday, then that price being whatever the EMA value was yesterday, then we'll exit the position rather than trying to predict where the 5-day EMA is going to close today. So with that, this is the equity curve we get. And this is something that I'm personally willing to trade. Now, the equity curve is not quite as smooth looking as the RSI version because the RSI version was capturing really extreme overbought values, which in theory might have potentially a better edge. But this meets the 100 trades criteria that I personally have a standard for. The total P&L is about 10% higher. The drawdown is slightly higher, but the win rate is also higher, about 10%, rather about 7%. And then the profit factor is much higher than the RSI version. And so to me, this is something that might actually be a more realistic edge, realistic strategy. And this is something that, especially because of its recent performance, has been very good, is something that I would consider trading in the market. And I do trade a variation of this in my portfolio of SPY strategies. But yeah, so hopefully this answers your questions about how you would develop not only a trend following strategy, but specifically a strategy for SPY whenever it's in a bear trend. And in the next video, we'll go ahead and dive into how to actually code all these entry conditions and exit conditions with toggles. So you kind of toggle them on and off and kind of see how certain entry conditions and exit conditions affect the overall equity curve. And lastly, I just want to say that if you're not a member of our community, please consider joining via the Patreon. We talk a lot about trading, about multiple income streams, and honestly, just about capturing edge in different ways in life. And it goes beyond making money. It's honestly pretty incredible, the stuff that we're working on. So definitely check that out if you have not. But if you're just here for the trading strategies, well, I mean, all of these are ones that you can actually code, vet for yourself, and start trading, or at least sim trading. And hopefully it'll, if you've been following along, it helps you out in some sort of way in your trading journey.